The Bank of Canada has just announced its first rate cut since the last 4 years, and the least we can say is that it was warmly welcomed by many Canadians across the country. So today we'll take a look at what this news means to us and how this will affect many Canadians and their finance for the future. As most of you must know, after being at its all-time low for about 2 years, the Canadian interest rate has started to rise up in March of 2022 to peak in the summer of 2023 to about 5%, which was the highest point that it has reached since 2001. This series of hikes of the interest rate were an attempt to slow down the inflation that reached a point of 8.1% of inflation in June of 2022, and in fact the strategy of the BOC has worked pretty well up to this date. In fact, the Bank of Canada's objective and target is to lower the inflation to a target of about 2%. As of April of 2024, we see that the CPI, or the measure to see what is the inflation, was of about 2.7%, which is still slightly higher compared to the target of the BOC, but way lower compared to what it was in June of 2022. And so this has convinced the governor of the Bank of Canada, Tiff Macklem, to ease its monetary policy to lower the policy interest rate to about 4.75%. This happened because in their more recent data, they've been noting that the underlying inflation is easing and returning close to their target, meaning that the monetary policy no longer needs to be as restrictive as it was previously. This arrives after Canada's growth resumed in the first quarter of 2024, where we've seen that their global GDP growth have been increasing by about 1.7%, despite the stalling growth that we've seen in the second half of 2023. In the more recent meetings of the Bank of Canada, we've seen that its governor has even said that with their expectations that the inflation will slowly go down to 2%, it would be reasonable in that case to expect further rate cuts in the near future. Nevertheless, he has mentioned that he continues to take one decision at a time and that the board continues to monitor the overall situation to make sure that we keep a great balance between the demand and supply in the economy, the inflation expectations, the wage growth, and the corporate pricing behavior. So now that you know what just happened, it is crucial for you to understand what will be the impact in your life. First, you need to know that the policy rate that is determined by the Bank of Canada will have a direct impact on the Canadian bank's prime rates, and these prime rates will have a direct impact on the interest rates that will be present by these financial institutions. This means that by reducing the policy rate and at the same time the interest rate, this will give more power to the potential home buyer that will want to have their new mortgage, and this could also help different borrowers that currently have a mortgage on their house. The thing is that it will help only the ones that have a variable rate and not the one that will have a fixed rate. Indeed, while variable rate borrowers will have a certain relief to see the interest rate decrease where they'll be able to repay a certain part of their capital faster or to have some lower payments, well, this doesn't have any impacts on about 3/4 of Canadian mortgages that are currently at a fixed rate. At the same time, people that will be investing with these financial institutions in different high-yield savings accounts will also see their total return from these accounts reduce. In fact, this is the case because one of the side effects of the policy rate decrease is that by reducing the total interest rate, this will also reduce your total return on this investment. Take the example of the cash ETF that will invest all of its capital in 3 high-yield savings accounts from the big Canadian banks. Well, a few months ago, we've seen that the rate offered by this ETF was over 5.40%, where it is now standing at about 4.80%. However, on the upper hand, investors that will invest in high capital expenditure companies that have a lot of debt, for example, great Canadian dividend stocks, well, these companies will see with a good eyes the decrease of the interest rate because it will mean that they will pay less interest on their total massive debt, which will also help them to achieve more profitability and at the same time potentially gain even more value in the long term. Also, by lowering the policy rate, the BOC will give more borrowing power to the people that will want to make new big acquisitions, for example, the buying of a new car or of a new home. In fact, this will make that consumers will pay less interest and so they will have more money to inject in the economy and to buy new things. Unfortunately, this will also impact impact negatively certain things, for example, the real estate market in Canada. Indeed, while we are currently in a housing shortage in the country, by reducing the interest rate, this will affect highly the total demand of people that will have the possibility now to buy a new house. And so according to the demand versus supply rule, this will massively increase the demand of new home buyers and at the same time increase the total price of the housing market in Canada. It is why I believe that the BOC won't be able to make consecutive rate cuts in the next couple of months, because this will make that the real estate market in the country will become even more unaffordable for the new buyers. But on a more positive news, I believe that this is sending a pretty good signal that we are currently seeing the end of the pandemic and of its financial distress effects on our lives. This will also give a good fresh air of breath to everyone that has borrowed money at the beginning of the pandemic before the numerous hikes of the interest rate with a variable rate. Unfortunately, at the end of the day, Canada still has major economic problems that have been heightened by the pandemic, notably in terms of the total immigration versus the number of new constructions, as well as their massive debt. This also means that by making the cost of borrowing more affordable for the global population, we might assist to another outbreak of the real estate prices over here in Canada. And so this will mean that younger families and younger people might have even more difficulties to find new houses if the price of real estate continue to increase at the same speed that we've seen in the past. It is why I believe that it is crucial for anyone to start investing as soon as possible to be able to eventually buy your first house if you have this objective. And so if you want to find my personal story on how I've been able to buy my first triplex at age 24, well, check out the video that's going to be right over here, and I will see you soon. Peace!